So, in the first half of 2026, U.S. investors they were so spooked by the global economy that they pulled over $48 billion out of equities.
Right, which is just a massive retreat.
Exactly. I mean, they looked at inflation, the geopolitical tensions, all the sluggish growth, and just decided it was time to pack it in.
Yeah, completely risk-off behavior.
But then, during that exact same 6-month window, everyday Indian savers looked at that very same global economy, and they poured a massive 1.8 trillion rupees right into the most aggressive parts of their domestic stock market.
It's wild. It's a complete divergence from the global trend.
It really is. So today is Wednesday, August 26, 2026. And our mission for this deep dive is to figure out why this massive divergence is happening.
Yeah, because it goes against all the traditional models of how emerging markets are supposed to behave during global uncertainty.
Right. And to do this, we are looking at 2 new releases today. We've got the AMFI monthly note for July 2026 and the AMFI Crystal Factbook 2026.
Both of which are just packed with data that totally challenges the old narratives.
Seriously. What these sources reveal is basically a fundamental rewiring of the Indian economy. And it's driven not by, institutional wizards on Wall Street or Dalal Street, but by domestic households.
Yeah, everyday people.
Exactly. So whether you listening are figuring out your own asset allocation or just trying to understand global market resilience, this is the blueprint. Joining me to decode all this is, as always, our resident analytical brain.
Hello to you listening. And, the reason these 2 reports are so crucial right now is that observing where the money actually flows, not just what people say, but the actual capital, gives you the ultimate map to the broader economy.
Right. Follow the money.
Exactly. We often get caught up in, government press releases or those high-level macroeconomic forecasts, but capital allocation tells the real story. And the capital map of India right now is showing a transition that emerging markets, frankly, rarely navigate successfully.
Okay, let's unpack this, because before we can understand how your own portfolio strategies might apply here, we really have to grasp the sheer physical scale of what is happening in the Indian markets right now.
Yeah, the numbers are just staggering.
They are. In July 2026 alone, the mutual fund industry's assets under management, so the total pool of money they actively manage hit Rs 85.76 lakh crore.
Which, just to put that in perspective, represents a 4.3% jump in a single month.
1 month.
Right, which points to a much larger structural trend when you map it against the size of the country's entire economic output.
How so?
Well, the industry has grown its assets under management, or AUM, to a historic 21.3% of the country's GDP in fiscal year 2026.
Wow. Over 20%.
Yeah.
Yeah.
And if we look back just 5 years to 2021, that ratio was sitting at 15.9%. So the financial sector is expanding much, much faster than the underlying economy itself.
Okay, the stat that really contextualized this for me, though, involves public ownership. So the share of domestic mutual funds in NSE-listed companies, meaning companies publicly traded on the National Stock Exchange, that rose to about 23%.
Right, nearly a quarter of the market.
Yeah, and back in March 2021, it was only around 15%. So domestic mutual funds now own a massive chunk of the public market.
Which completely changes the market dynamics.
It totally does. I mean, it used to be that the Indian stock market was like a house party where everyone panicked if the wealthy foreign guests, the foreign institutional investors or FIIs decided to leave.
Yeah, the old saying was, if foreign capital pulled out, the music stopped and the local market crashed.
Exactly. But now, the local neighborhood has so much cash, they're basically keeping the party going all by themselves.
I love that analogy. And if we connect this to the bigger picture, that dynamic explains a historical vulnerability in emerging markets.
Because usually they're so dependent on foreign money, right?
Yeah. Right. Usually if global interest rates rise, say, the U.S. Federal Reserve hikes rates, foreign capital just flees emerging markets for the safety of U.S. bonds. The local currency tanks, and the stock market collapses.
A total domino effect.
Exactly.
Yeah.
But the 4-month period leading up to July 2026 provided a perfect stress test for your house party analogy.
Oh, because the foreign investors were heavily selling off Indian equities then.
Yes, they were dumping them. But instead of a market collapse, domestic liquidity simply absorbed the shock. When July rolled around, domestic institutional investors, or DIIs, bought equities worth Rs 30,200 crore.
Well, the foreign investors who finally returned to buying that month only brought in Rs 20,200 crore.
Exactly. The local institutions outbought the foreign institutions by a massive margin.
They basically created a floor for the market.
They did. And for you listening, the reason this matters goes far beyond just stock prices. This domestic capital pool is the actual engine funding corporate expansion right now.
Building infrastructure, driving job creation, all of that.
Right. It is the direct financing mechanism for Viksit Bharat, which is the national initiative to transition India into a fully developed nation. Everyday retail investors are physically financing the build-out of their own country's infrastructure.
That is incredible. But it also raises the question of mechanics. Like, how exactly is the local neighborhood funding this multi-trillion rupee market expansion?
It comes down to a very specific behavioral shift.
Right, the SIP, the Systematic Investment Plan. In July 2026 alone, monthly SIP contributions hit a record Rs 31,961 crore.
And the mechanism of the SIP is vital here. It relies on automated, frictionless clearing.
Because of India's digital public infrastructure, right?
Exactly. Specifically, the Unified Payments Interface, or UPI, and just the massive smartphone penetration across the country. Investing is no longer a matter of, taking an afternoon off to fill out physical paperwork at a bank branch.
Yeah, nobody wants to do that.
Right. It is an automated digital deduction. That technological friction removal is what creates such a predictable, recurring pool of capital.
And the numbers completely back up that scale. I mean, there are now 9.90 crore active SIP accounts.
Almost 10 crore accounts. It's massive.
Yeah, and those accounts represent 21.2% of the industry's total AUM, sitting at ease 18.20 lakh crore. Plus, in just the 12 months leading up to March 2026, the industry added 78 lakh unique investors.
Moving from 5.36 crore to 6.14 crore unique individuals.
That is just explosive growth.
It is. And the demographic expansion hidden inside those unique investor numbers shows a real broadening of financial access.
Like good women investors are.
Yes. Women investors are managing Rs 15.88 lakh crore as of March 2026.
Wow.
Which accounts for 34.5% of the total individual AUM. And that's a staggering increase from just Rs 5.84 lakh crore back in 2021.
That's almost triple. And geographically, it's pushing way past just Mumbai and Delhi. The reports highlight this massive acceleration in what they call B30 cities, towns and cities beyond the top 30 metropolitan areas.
Yeah, distributors are physically opening offices and expanding their footprints into these Tier 2 and Tier 3 cities.
Okay, I do have to push back on the optimism here, though.
Sir, go ahead.
Because we see 9.90 crore accounts, and we assume it's all this sophisticated investment strategy. But is a SIP for a first-time investor in, say, a Tier 3 city just a digitized piggy bank?
What do you mean?
I mean, if the market takes a massive 20% hit, won't these new investors just panic, hit the sell button on their smartphones, and pull all that liquidity right back out? Like, are we actually seeing a permanent psychological shift in how everyday people view market risk?
It's a fair question, but the data from the past several years of market corrections provides a pretty clear answer.
Okay, what does it show?
Well, the Indian household savings model historically relied really heavily on physical assets. Buying real estate or physical gold jewelry, these were seen as safe, tangible stores of value.
Right, things you can hold.
Exactly. What the SIP data demonstrates is a massive formalization and financialization of those savings. They are actively choosing digital financial assets over physical ones.
I guess because physical real estate is super illiquid, and gold jewelry has crazy high markup costs.
Exactly. Plus, we can actually see their behavior during volatility. During sharp equity market corrections over the past year, the SIP momentum didn't stall. It actually grew.
Wait, really? It grew during a downturn?
Yes, which indicates that these investors inherently understand the mechanics of rupee cost averaging.
Okay. Let's make sure we clarify that for the listener really quick. Rupee cost averaging basically means that because you are investing the exact same amount of money every single month, say 5,000 rupees, the math naturally works in your favor during a downturn.
Right, it's automatic.
Yeah, when the market drops, your 5,000 rupees automatically buys more shares of the fund. And when the market is expensive, it buys fewer shares. So it removes the emotion and just averages out the cost of your investment over time.
And that mechanical discipline is precisely what everyday investors are trusting right now. They aren't trying to time the market tops and bottoms.
Because no one can really do that anyway.
Exactly. They are utilizing the SIP to automate their wealth creation, which creates this organic, durable growth for the broader market, basically shielding it from sudden liquidity panics.
Okay, and that discipline actually explains a massive divergence in the global data. Because Indian investors aren't panicking, they are making bets that seem terrifying to the rest of the world.
Right, going back to what we touched on at the very beginning.
Exactly. Here's where it gets really interesting. Let's look at the contrast between Indian investors and U.S. investors in the first half of 2026.
The contrast is jarring.
It really is. The U.S. mutual fund industry saw investors pull $48,331 in crore out of equities and another $4,308 crore out of hybrid funds.
And where did they put it?
They flocked heavily to debt funds, pouring in $19,314 crore.
Yeah, that is a textbook flight to safety. When investors fear recession or geopolitical instability, they sell off riskier company stocks and buy bonds and debt instruments to guarantee a return, even if that return is lower.
Meanwhile, during that exact same 6 months, India saw equity inflows of Rs 1,080,778 crore, and they were actually abandoning debt.
Right, massive debt outflows.
Yeah, we saw debt outflows of Rs 1,036,566 crore in that half year. By July 2026, Indian equity funds logged their 65th consecutive month of positive inflows.
65 months. Over 5 years without a negative month.
And they are pouring money heavily into small-cap funds, too, putting Rs 7,768 crore into that highly volatile category in July alone.
Though we should note, Indian debt funds did experience a sharp bounce back in July, with an 11.3% AUM increase.
Oh, really? So they did go back to debt a little bit.
They did, but that was almost entirely driven by short duration and liquid funds, so essentially cash equivalents, because short-term yields remained highly attractive.
Ah, got it. So investors were just parking cash temporarily, not necessarily locking into long-term debt like the U.S. investors. Still, the broader trend is wild. Why are Indian investors pouring into volatile small-cap companies for 65 months straight, while American investors retreat to the safety of debt? Is India living in an overly optimistic bubble, or is the U.S. just overly pessimistic?
This raises an important question about how macroeconomics actually dictate investor behavior. The Indian investor isn't just operating on blind optimism, they are responding to domestic fundamentals.
Like the GDP numbers.
Right. The IMF projected a 6.5% GDP growth for India, keeping it positioned as the world's fastest-growing major economy. The economic engine is physically expanding at a rapid pace.
So corporate earnings are growing, businesses are expanding, which means the underlying value of the equities is actually rising.
Exactly. And you also have rising per capita income. As households earn more, they look for yields that will meaningfully outpace inflation.
Right, you want your money to actually grow.
And the report compares the compound annual growth rate, or CAGR, over the last 5 years. Traditional bank deposits grew at a CAGR of 11.2%, but the mutual fund industry's AUM clocked an 18.6% CAGR over that same period.
Okay, I need to stop you there, though, because 18.6% versus 11.2% isn't really an apples-to-apples comparison.
How so?
Well, you are comparing the guaranteed risk-free return of a bank deposit with the risk-adjusted return of an equity fund during a historic bull run.
That's a fair point.
We can't just say one is strictly better than the other. They carry entirely different risk profiles. Do these retail investors actually understand the risk they are taking to get that 18.6%?
The data actually suggests they do understand the risk, which is why the shift is so profound. Think about it. The U.S. investor is currently navigating a mature market dealing with stubborn inflation and potential recessionary pressures.
So retreating to debt makes logical sense for them.
Exactly. But the Indian investor is navigating a rapidly formalizing high-growth economy. They are accepting higher equity risk because the macroeconomic environment, the infrastructure spending, corporate earnings expansion, it fundamentally supports the potential for higher yields.
Okay, that makes sense. But they aren't just gambling everything on high-risk equities either.
Not at all.
Because when you dig deeper into the AMFI crystal report, you see incredible sophistication in how retail investors are protecting their downside.
Yeah, their hedging strategies are getting very advanced.
Look at commodities. Commodity ETFs, specifically gold and silver, actually attracted more inflows than equity ETFs in fiscal year 2026. Gold ETFs alone clocked a 156.2% jump in AUM over the past year.
And that shift from physical gold to digital gold ETFs is a massive efficiency upgrade.
Right. No more keeping gold bars in a safe.
Exactly. Investors avoid the making fees, the storage costs, and purity concerns while still using gold for its primary financial purpose.
Which is being a non-correlated asset to hedge against global uncertainty, right?
Exactly. When equities drop, gold typically holds or increases its value.
And they are also heavily utilizing hybrid funds. The AUM for hybrid funds went up 2.1% in July.
Especially the multi-asset allocation fund.
Yeah, the ones that automatically balance your money across equity, debt, and commodities. Those just saw their 59th consecutive month of positive flows.
But I'd say the absolute most fascinating piece of this report is the sudden rise of SIFs.
The specialized investment funds.
Right. SIFs represent a brand new, highly regulated middle ground created by the market regulator, SEBI.
Who is it for, exactly?
It basically caters to a maturing investor base that wants more complexity than a basic mutual fund, but doesn't have the massive capital required for a traditional portfolio management service.
Okay, for you listening, think of it this way. If a traditional retail mutual fund is like a massive cruise ship, it's very safe, highly regulated, everyone is on board, but it is very slow to change course and can only travel in deep, safe waters.
I like this.
Well, a SIF is like a regulated fleet of speedboats. It gives the fund manager the agility to use complex derivatives, targeted long-short strategies, and specific hedging tools that simply aren't legally permitted in standard retail funds.
But you still have the safety net of the maritime regulator, SEBI, keeping a strict eye on the fleet.
Exactly. And SIF AUM jumped 29.8% in just 1 month, hitting Rs 23,177 crore in July, mostly driven by hybrid and equity-oriented strategies.
What's fascinating here is the duality of the retail investor's behavior.
Meaning they are doing two seemingly opposite things at once.
Yes. We see 65 months of aggressive inflows into small and mid-cap equities, which looks like pure, unadulterated risk-taking.
Right, going all in on growth.
Yet simultaneously, there is a massive calculated surge into gold ETFs, multi-asset hybrid funds, and these highly structured SEFs.
So they are actively trying to capture alpha, meaning they want returns that beat the broader market, but they are using advanced tools to build a safety net at the exact same time.
Exactly. They understand that capturing high growth in a developing economy requires equity exposure, but protecting that wealth requires non-correlated assets and sophisticated allocation.
It completely shatters the myth of the naive retail investor.
It really does. They are building complex, all-weather portfolios capable of surviving market shocks.
So what does this all mean? When you look at the AMFI July note and the 2026 fact book together, the core takeaway for you, the listener, is that the playbook for wealth creation is democratizing.
Very much so.
The smartest play, validated by millions of domestic savers, isn't obsessing over market timing or reacting to every single global headline.
No, it's about discipline.
It is utilizing the frictionless discipline of automated SIPs. It is embracing broad asset allocation mixing, high-growth equities with commodities, hybrid funds, and perhaps exploring SIFIs to hedge your bets, so your portfolio can weather whatever global storms are raging outside.
It is a masterclass in behavioral finance playing out in real time across an entire population. But I do want to leave you with a final thought to consider.
Okay, let's hear it.
We spent this deep dive analyzing India hitting a historic 21.3% AUM to GDP ratio. We discussed the massive milestone of 85 lakh crore rupees.
Right, which sounds huge.
It does. But the global average AUM to GDP ratio currently sits at 74%.
Wait, 74%? That is a massive gap.
It's huge. Think about the sheer physical volume of capital that will flood the domestic market as India closes that remaining 50-point gap over the coming decade.
Oh, wow.
If the current market valuations, the infrastructure build-out, and the corporate growth all seem unprecedented today based on just 21.3% participation, what happens to the global financial landscape when the rest of that domestic capital is finally unlocked?
That is a staggering thought to end on. Because we're really just at the beginning, aren't we?
We really are.
Well, thank you for joining us on this deep dive. Keep exploring, keep questioning the numbers, and we will catch you next time.